Hello, everybody. It's been a long time since I've come back and recording the weekly wrap for all of you. I really miss doing it. I think it was somewhere in the middle of November that I did my last podcast. And after that, I came down with a viral and I could not speak clearly for a long time. There was too much cough. And then at the end of December, I was struck by a personal tragedy when I lost my mom. It's taken me some time to get back to work. And here I am coming back along with Hiloni to do a wrap. So we thought, since there's been a long gap, we'll catch up on some of the the annual trends that have shaped 2025 and give you our take on that and what to expect in 2026. And I never believe in predictions, but well, we'll give it a go. What do you say?
Yes.
So the first trend map that Hiloni has pulled up for us talks about how mid cap, large cap, micro cap, and small cap have done over the last 10 years. So, Hiloni, what say you?
So, if we see a trend of the last 10 years, micro cap has delivered around 20% CAGR. But I must tell you that this year alone, in 2025, micro caps have fallen a lot. So just to give you a number, 50% of the stocks have fallen more than 40% from their all-time highs. So
while the 10-year record looks good, actually, if I look at all the calendar years, 1, 2, 3, 4, 5, 6 out of 10 years, micro cap tops the league chart. Okay. And that alone should convince any investor that, hey, that is the place where I should put all my money in. And that's where I can make my wealth. But the fact of the matter is, half the time you could go wrong. How risky is that? You might as well go to the race course and bet on horses or play a game of poker. So you want to be steady, you need to you need to go greater up the capitalization table where returns are more predictable. Okay. So just below micro cap comes mid cap with an 18.3% CAGR for the last 10 years, then small cap, and then large cap with a 14% CAGR of the year. But large cap more dependable than the micro cap. And it's only when you try to go build positions in micro cap do you understand the challenges. Buying is one thing and selling is another challenge altogether. The price that you see is not the price that you get when you're selling. Given that liquidity is so low in these counters, the moment there's a seller, the price drops. Which is why SEBI recently ruled against asset management company coming out with a micro cap index fund. Because the moment you have more and more people filing into the index fund, the index operator is going to have a tough time rebalancing. Because if he's going to exit a large position to buy some other position, everything goes wonky, everything goes haywire. I think it was a wrong decision on the part of the AMC to try and put up a microcap index fund in such a hot market. And I'm so happy the regulator took a good view of all this. As financial advisors, we can see that it's a very risky venture and could have a large tracking error. So that's a brownie point for the regulator. We don't always say that, but then there it is. And what are the other trends that you have going for us?
Yeah, so one more thing, if we note right, the large cap, as you mentioned, had 14% CAGR and small cap has 14.8% CAGR. So you're taking a lot more risk for a very nominal, incremental return.
Incremental return. Very well said.
Yeah.
And of course, the huge drawdowns that we experience in micro cap and small cap, we don't experience in large cap.
Correct.
Okay. So, for example, 2018, 2019, the index itself over the 2 years fell by more than 50-60%, which we rarely see in others. If the index itself fell by 60%, you can imagine what happened to some of the constituents, which would have fallen way more than 60%. It would have been a bloodbath. It was a bloodbath. I do remember what happened in those years. It was a bubble in small and mid cap stocks, and when the crash happened, it was triggered by the credit crisis. It was very, very bad. No people didn't have the guts to get back into mid and small cap for quite some time to come. And then we have another rally recently.
Okay. Also, at that point, it's painful to sell. If
You
an
can't
individual
sell.
doing is DIY,
There's
yeah,
no
of course. Correct.
Even if you want to sell. Yeah, let's go to the next one. So this is a favorite chart for many, right?
Yeah.
This is about different asset classes.
Yes.
We are talking about silver, gold, real estate, equities, and bonds, etc. And no prizes for guessing who's on the top of the 10-year chart. It is silver and followed by gold. Okay. So that's been the hot topic. And any meeting we go to, any client we speak with, any manager we speak with, the topic is what's going to happen to silver, what's going to happen to gold. Should I buy more silver? Should I buy more gold? Right? Like we've spoken in our earlier podcast, whenever the chart is parabolic, it's going up like this, we don't want to enter it. Okay. Whatever be the fundamental, it will be proven wrong. So we do think that is there's a lot of steam left, and one should be very cautious in buying any of these precious metals which have gone a huge rally up. People do talk about the gold to silver ratio, and that needs to be rebalanced because silver has run up far more than gold in the recent times.
Correct.
So the expectation is that gold will also move up.
Yes.
Or silver moves down.
Yeah.
Both of them could correct the ratio, right? So let us see what happens actually. It is true that there's a greater industrial demand for silver, but it's also true that much of the silver positions are held by speculators and not industry users. So that makes it speculative, even if there's a real industrial demand for the metal.
Also, if you have recently, last week, we have been trading at premium. Silver has been trading at a premium than global.
Yeah.
So yesterday all the silver ETFs were down like till 15%, but today again it has gone up by 7-8%. So it's a very euphoric market in that sense for silver.
Very volatile. The thing is, there are no predictions here. The only predictions that are there are maybe very long-term in nature, very structural in nature, but nothing explains this short-term euphoria or the present euphoria. I do not know whether it's going to be short-term. Euphoria can very often outlast logic. So I will take back my words about short-term. Okay, it could go on and on. So the factors that have been shaping precious metals, just to revise it, are geopolitics and the trying to get away from the US dollar and finding alternative methods of investing by central banks and large institutional investors. That has driven the gold and silver rally. And every time the US president makes a comment, markets take a dizzy. Okay, so either they go up or they go down, and within 2-3 days the statement is reversed and markets also react in the other manner. So I do think those who are making the statements or who are in control of the statements or in the know of the statements could make money, but the lay investor better stay off speculation because nothing is in their control.
Yeah, even if you are experiencing FOMO at this point.
You should have fear of losing out. Your money. Not the
That's true.
Not the fear of losing out on a trend. You should have the fear of losing your money when you take part in these. But the way things could be going on, while much of the gold and silver demand is happening in the non-Western world, it's in the non-developed markets, right?
Correct.
The developed markets don't own much of gold and silver. And at some point of time, maybe even now, they will be feeling this and they will do everything in their power not to let gold prices go up too much. They will have to come up with a counter, and that counter could be stable coin.
Correct.
So it could be the developed markets with stable coin, with the global south, and the other markets with gold and silver. Let's see where it takes us. Nobody knows. Okay. And real estate was at the bottom of the chart, right?
Yeah.
Well, for all the real estate junkies out there, real estate was at the bottom of the chart, and precious metals were at the top of the chart, and equities were right below the precious metals. Actually, equity in India and gold in India, they are not too far apart. So if you didn't buy gold but had enough equity, you still made money.
Correct.
On the 10-year period. So I don't think you should be overly concerned that your portfolio didn't have enough gold. As long as you had reasonable amount of even large cap equity, you would have made sufficient wealth. So chill, sleep well. But yes, I think maybe in the long term, one should build up positions in precious metals, it will come in use.
Yeah. Agreed. So a 10% structural allocation to gold is actually a recommended part of our portfolios as well. And we have seen in our backtesting and our portfolio construction that it actually gives you an edge over having a zero gold portfolio. Even over the 10-year period, if you had a zero allocation to gold in your portfolio, your 10-year return would have been somewhere around 11.2%. But if, say, for example, you had equity at 70%, debt at 20%, and gold at 30%, which is a typical 70-30 portfolio that we build, you would have made us 12.4% returns over the 10-year.
Not much of a difference.
Yeah.
Correct?
But
as long as you had equity. If you did not have equity, you would have been a loser. Correct. So one should keep in mind that have enough equity, whatever happens, there's a whole lot of noise that is happening. And the intelligent investor should learn to distinguish between the noise and what is reality. So what tends to make the headlines does not necessarily influence financial markets. Yes, we are worried about what's happening in geopolitics around the world, but is that necessarily going to have an impact on long-term economics? May not. So looking at what's happening over Greenland, you may neglect to build up an equity portfolio. You may be in a world of say, oh my lord, the markets are going to crash. They won't crash. There's nothing to make them crash. There are enough people to buy stocks. Okay. So I'm just trying to build contrast that the noise may not necessarily determine the long-term future of strong asset classes.
Okay.
So a good asset allocation is going to work better for you than trying to time the market and swing to extremes. You'll never know what hit you. And then it's too late to try and correct your portfolios.
So would you say that building a portfolio from a top-down approach that way, asset allocation becomes more important than nitpicking on which scheme or which category I am in? Asset allocation becomes more important in that sense.
Any number of studies have proven that it is asset allocation which determines long-term return, and not exactly which stock or which fund that you have in the portfolio. So before you pay attention to the constituents, pay attention to the broader asset allocation.
How are your assets distributed?
How are they distributed? Are they sufficiently distributed? Do you have the right amount of equity? Do you have the right amount of bond? Do you have the right amount of real estate? That will determine long-term returns more than anything else.
That's where even risk profiling becomes a very important part of our analysis and portfolio building.
Correct. So the risk profile in this context can show you that you are okay to have some equity. You may not be having much equity, but a risk assessment may show that you are capable of taking some equity risk, and that will help build long-term return, which you may have otherwise missed out by not being in that class at all.
Agreed. So the next chart we have is on global equities and how they have done.
Yeah. All right. So surprise again, this chart seems to be saying that Brazil has led the 10-year CAGR at 13.7% per annum. That looks strange, no?
Yeah.
It's not been there in the news at all till Trump started fighting with their president Lula. And here we see that Brazil is topping the chart. It's true that emerging markets have done well.
Yes.
Okay. So emerging markets go through very long cycles, and they're contra cycles. When the dollar is weak, interest rates are low, emerging markets do well. Okay. And the last few years, the focus has been overly towards USA, to the detriment of all other markets.
That's true.
Okay. You want to talk about US exceptionalism? It's also shown here. Okay. And now the trend is the other way around. It is the sell America trend now.
Yeah.
Because nobody wants to be getting caught in the crossfire when it happens, or if it will happen between Trump and the rest of the world. And valuations are high. So nobody wants to take the risk. So given that, when we see Brazil up there on top, followed by India, so US should have been there on the top, right?
Correct. So in this heat map, we don't have S&P 500. We have NYSE Composite. But if we consider S&P 500, then it will come on top. So S&P 500 has given us 14% return in 10 years.
Yeah. So this map has NYSE, the New York Stock Exchange Composite Index. And the S&P 500 has more of tech stocks.
Yeah.
And that is what all of us look at more frequently than the other indices. So that would have been right at
The
top,
winner, yeah.
followed by the Bovespa of Brazil, and then India. Though 2025 India's was at the bottom of the table. Sorry, okay, led by Brazil and the what's the next the
Germany.
Germany, Europe. Europe had a good resurgence, and as we will see later, multiples also look pretty good there for some more sustained run as far as Europe is concerned. People are looking at other countries, and rightly so. They've been terribly neglected. Okay. So again, the whole idea of discussing a trend map is that diversification is the key, and even within countries, across countries, diversification is the key. Hanging on to any one country would not have given you a steady return
Correct.
at all. Correct.
Yeah. Again, China is at the last, right?
At the
That's
10 year,
another one
China's
that
at the
has,
bottom of the
yeah.
10-year CAGR. But the second half of this 10-year, China has been
Correct.
doing very well, isn't
Yes.
it?
Yes.
So that is something to be noted.
Correct.
And even now, Chinese multiples are
Looking good.
yeah, looking good, not as high as the rest of the world. So what's driven returns over the last few years, over the last 5 years? So we have this interesting chart we are looking at. Is it earnings growth that has driven stock market gains, or is it P multiples being re-rated either up or down that has driven returns? So a stock price can go up just because people think it will do much better in the future and assign it a higher PE. Okay, so that's a valuation re-rating. Or valuations could be in the same range, but the profitability of the company could have gone up, earnings could have gone up, because of which the stock price goes up. Okay, so there are two different factors. So stock price growth is a function of earnings growth and valuation re-rating. Okay. So apart from 2021, almost all the other years, we see that that year's index growth has been driven by earnings growth and not valuation re-rating. Okay, so in 2020, the 20 to 25 5-year market return has been 17% compounded, of which earnings growth has determined more than 20%, and a valuation re-rating, de-rating of 4% took away 4% return. Okay, and dividend yield of about 1%. So you can see that this is the fundamental. Over the long run, market returns are determined by earnings growth. That is the one factor you should keep looking at and not get distracted by anything else. This is fundamental. It is not noise. If you see earnings growth, whatever you project earnings growth to be, that is the return you get out of your stock price of the index or the stock that you buy. Correct? So over and over again, across markets, we see the same fundamental playing out over the very long term. Market returns equals earnings growth.
Correct.
Okay. So in that sense, last year we saw just 11% earnings growth from the broader constituents of the Indian corporate. And we saw that nominal GDP growth itself came in very low, okay, which is why top line didn't grow.
Correct.
Is it not? The projections for the next year is that nominal growth will be around 10 to 10.5%, which is far better than the 8.25% we saw last year. So in that sense, if that turns out well, we can estimate or assume that top line growth of Indian companies will be better than last year. Isn't it?
Yeah.
But we did see a hit on margins last year.
Yeah. So we had a problem on our end, right? So we had key triggers in the market. If you see in the equities, which we have seen in the past, are 2-3. We had a direct tax rate cut, which came into picture in your Q1. You had a GST rate cut recently, where we are expecting the the benefits of it to come in the next quarter, this quarter where the earnings season has started. There was a drag in that sense that Indo-US treaty was just not happening, right? So that was another pressure which was happening over there. Again, that could be one key positive factor for this year that we can keep an eye out for.
Yeah. So while earnings growth is still expected to be dull in 2026, and we have seen a time correction in India.
Correct.
So it's not a whole lot of optimism, by the way. Okay. We've seen time correction. We have seen continuous outflows by foreign institutional investors. We are not seeing many signs of earnings growth. Q1, Q2 are pretty dull. Q3 is coming in, so far nothing good, except for one or two sectors like the banking and financial services and automobile and maybe infrastructure a little bit. Nothing else is there to drive earnings growth on a broad index level. So no great optimism there. We also saw profit margins fall last year.
Correct.
And I'm hoping they should recover, but I'm not seeing any reason for them to go up yet. So overall, a dull market could turn out to be, unless we see some annual spirits come back in because of either some good provision the Honorable Finance Minister makes in the budget, or we have the Indo-US trade deal go through at some point of time, which will remove the uncertainty relating to geopolitics. Okay, yes, IT will probably do better, and some of these export sectors could do better. But then broadly, I think more it is a sentiment which would improve, and you will find foreign institutional investors willing to come back to India. And along with domestic investments which remain unabated, the other pillar also comes in, and the markets could do better. So any of these one or two triggers could be there. Otherwise, if these triggers don't happen, I'm not seeing a very ebullient market in the current year. So better to remain diversified, better not to take risks. The only couple of sectors looking good at the moment are banking, automobile, maybe infrastructure driven.
Yeah, but again, I feel investors have to be picky because the valuations are high, and one of the indicator is the overheated IPO market that we are seeing right now in the country.
True.
So valuations are very expensive still. So there would be select pockets. So it's very important to be picky in what you are investing in.
Yeah. So mid and small continue to remain expensive. Large, not as expensive. That as a category, it still looks somewhat investable. But yes, as Hiloni says, you got to be very, very picky and careful, because as we will probably discuss in our next podcast, how is it that one can get outperformance?
Yeah.
Okay, so Hiloni has done some work on that, so we'll bring up some of those numbers and explain to you how tough it is to get outperformance. Not going to be an easy market, folks, but there are tricks that one can have up our sleeves, and we do have some tricks up our sleeves to handle this kind of uncertainty.
One thing that was popping out is how dividend yield has been at 1%
all the time.
Yeah, so in a way, the securities have been paying out to the market.
Yes.
So the dividend has been constant in a way. I mean, majority could have been driven by IT. I'm not sure there.
But it's remained such a small, tiny constituent of overall returns at 1%.
Correct, 500, yeah.
For a market like India, it really doesn't matter. In any growth market, dividends will not be adding any value. Okay, so much of the return will come from growth and not from return of money to shareholder.
So then ROC would be a good, ROC or ROE is a good metric to look this at.
You can have a high ROE and you can have companies paying out most of their earnings as dividend.
Okay.
So the payout ratio is what you should be looking at.
Correct.
Okay. So if a company is growing, it will keep the capital back to itself and not pay it out or return it to shareholder.
Okay.
So if they're keeping the capital back and not growing sufficiently, as you know, over time, the return on equity will keep falling, which is not a good sign. That's when you want to get out of that stock. So that's all, folks. And I'm happy to be back here along with Hiloni, back on the wrap. Okay. Good day. Have a good weekend.